What's going on, everybody, and welcome to the video. In this one, we're just going to be kind of going over how Warren Buffett values his dividend stocks. We'll be going over one of the top stocks, actually the top rated dividend stock on Seeking Alpha. We'll be using his valuation formula and showing you a little bit more. You know, whenever you look at Warren Buffett, there's a ton of different ways he values stocks. Just going to be using one of the said to be three-step ways that he values his dividend stocks. So if you do enjoy this type of content, I'll ask you to subscribe to the channel and you turn on post notifications so you don't miss out on any of my future content. But let's go ahead and get straight into the video. So first up, this is just kind of an overall look at my portfolio, just looking at all the different returns. If you want access to these spreadsheets, which we'll be using multiple of my spreadsheets that I use to kind of just manage my portfolio, research stocks, things like that, check out my Patreon and link in the description down below. We get access to all these different spreadsheets. The list goes on and on and on. There's tutorials, guides, everything you need to know on how to use these. Let's go ahead and kind of just get straight into it. So the stock we're going to be valuing is the first rated top quant dividend stock on Seeking Alpha right now. MPC quant ratings of 4.99, Wall Street ratings of 4.33. So we're seeing a lot of good stuff with this stock. I thought it might be a good idea to kind of just go ahead and use this valuation on it. So we'll be using the Warren Buffett valuation formula, and then we'll also be going through kind of my other spreadsheet right here, the stock valuation spreadsheet on a ton of different metrics, just to give you an overall overview of the stock. So this really works very simply. All you have to do is, I'll kind of show you, like I'll type in KO, all the information for Coca-Cola will come through. The only thing you have to manually input is a dividend growth rate, which will go back to the MPC because that is what we are doing. So I just type in the ticker in all caps, hit enter, all this information will automatically populate, and the dividend growth rate on MPC is 10.43%, which I did end up getting just a 5-year growth rate from Seeking Alpha, and you just put it in, and it kind of just helps you calculate these estimated dividends that they collect. And let's just kind of go ahead and break down how he does this before we go through all these different things. So finding stocks the Warren Buffett way. Buffett uses a number of different methods to evaluate share price. Three techniques are highlighted in his book with specific examples. So first up is the earnings yield, which is the earnings per share divided by the share price, okay? He likes to compare companies' earning yield to the long-term government bond yield. Right now, the 10-year government bond interest rate is about 3.75%. So anything around that seems to be attractive to Warren Buffett. And that's what he says. But also, whenever you get with the bond yield, that's just cash in hand and it's static, while the earnings of, per se, Nike in this situation should grow over time and push the stock price up. So pushing it up and also getting dividends is just kind of a 2-in-1, getting a lot more return than just an average bond per se. Now he also likes to use the historical earnings growth. Kind of just takes, you know, the earnings growth rate and you kind of expect how much you can get in earnings and then you get a share price. And I'll show you how it all works. But once this future price is estimated, projected rates of return can be determined over the 10-year period based on the current selling price of the stock. Buffett requires a 15% return at least. So for this example, all the math is in it. It just kind of shows you in this example they do. It has about a 17% projected rate of return. And then lastly, he uses sustainable growth, which he also likes to see a 15% return, but it kind of uses like the payout ratio, the book value per share, and a ton of different things that value the stock. But in conclusion, I'll show you this all in like practice in the spreadsheet. But for individual investors who want to duplicate the process, it requires a considerable amount of time, effort, and judgment in pursuing a firm's financial statements, reports, yada, yada, yada. Requires patience, again, waiting for the right price. Really what it comes down to is what they're trying to say is use these valuations, you know, get a better insight, but don't rely on these insights alone, okay? I'll kind of show you what that means because you can't just type in a few numbers and expect, okay, this looks like a great stock. You know, you have to go through the actual raw data in the companies. You got to look through more than just numbers, okay? You got to look at the actual company. But just looking at it from this information for the simplicity and to show you how this works, MPC, we get the earnings yield. 22.89% is a very, very high earnings yield. It's almost like too high, like questionably high. But we'll take it as a good sign for now because it does not have any triggering things. But then we go through the historical earnings growth. This is all the information you need to know. Step 1, I'll kind of show you. If you are interested in this PDF is going to be in the Patreon if you want to check it out. But it tells you everything. The step 1, the formula is used. Step 2, step 3. And so what he does is he takes that EPS, compound annual growth rate, times the trailing 12 months earning per share, raised to the 10, because he likes to see what is the projected stock price in 10 years. So with all these formulas, we get a total 10-year price target of $6,997 per share. Okay, that's a very high price target. And then right here for sustainable growth, use all these different numbers for all the formulas. Step one, you kind of just go ahead. I'll break it down into sustainable growth. You see the return of equity, and then you get the sustainable growth rate, which is right here. We see the sustainable growth rate to be 50.82%. And then step two, right here, you take the book value per share times 1 plus that growth rate to the 10th because it's 10 years. That gives you $3,636. And then step three, what we do, you take the return of equity times that, times the book value per share estimate. That gives us 2,022. And then from there, we take that earnings per share in year 10 estimate times the average PE. Okay, so here we go. Once you get all of that, you get a price target estimate, or you get 8,978. And then step five is going to be collecting all these dividends and adding them to the price. You get a $9,000 price target, which is very, very high. Okay, this is a very high estimate. Sometimes you just kind of have to look at it and not be that bullish because the 10-year upside is 6,000%, 6,300% exactly. Average price between historical earnings growth rate and the sustainable growth is $8,000, which is very, very high compared to its current price of $124. So this is just one way that he likes to value stocks. I mean, you can look at this with a bullish perspective. Sometimes you have to be careful because these numbers could come in negative and it can mess with the formula. So this is just one way he likes to value stocks. But I also want to show you how important it is to value stocks in other ways because these are 10-year price targets, just off of a few estimates. And you can't go off of these alone, but that is how he likes to value stocks to a certain extent. But now I want to show you kind of my way that I've been liking to value stocks. And this is just one of the steps. You also have to go through the raw data like I was talking about earlier. But you also get access to the spreadsheet by checking out the Patreon link in the description down below. We got MPC again. So first up is a DCF valuation. You just kind of enter in the free cash flows manually. The average growth rate is a little bit messed up because there's negatives. So I just gave it a future growth rate average about 5%. And then perpetual growth rate of 2% and a discount rate of 11% on this company. And typing in, the enterprise value, all these different things. What we can see is it has a DCF price per share of about $117. Current price is $124, downside of about 5.48%. Then we go to the dividend discount model. Here's the formula for this. You kind of just take the dividends into account and kind of get the present value of the stock, assuming a different few rates. And the dividend discount model price per share is about $163. I'll go ahead and zoom in a little bit so it's easier to see. Current price is $124. That's about 31% upside on MPC from the dividend discount model. Then for Graham's intrinsic value formula, MPC kind of has a negative growth rate, so I didn't want to mess up the formula. I just put it in the zero. Right now, their intrinsic value is said to be $55, which is 55% downside, assuming that the stock is a sell based off of this formula alone. Then we go to multiples modeling. You just kind of take in some companies, some competitors. It's very simple to use. You just really have to type in the ticker. Like I'll type in KO. All of Coca-Cola's information will load up. But remember, this was VLO, so I just typed that in. All information will come up. It kind of takes the PE multiplied by the actual earnings per share, the averages, it gives you the estimated price. Right now, it says MPC, based off this model, has about 3.97% upside. And the last one is a very simple one to use. You just type in the ticker, all this information will come up, and it gives you kind of an estimated price. But negative 33.33% is going to be the kind of estimated downside. So then we get the final intrinsic value for the stock by taking all five of these prices, 117, 163, 49, 129, and 83, kind of averaging them together, getting a final stock value about $108 from the current price of $124. That's 12% downside. You want to give it a little bit of margin of safety, so we're going with 10% right here, giving it a good price of only about $97. So right now the stock is said to be a sell because of the downside potential, just based on these valuations alone. So those are a few ways that I like to value stocks, and this is also how Warren Buffett likes to value his stocks. So if you are interested in this, check out the link in the description and Patreon down below. Get access to all these different formulas, these spreadsheets, a ton of great information. Thank you again for making it to the end of this video, and I will see you at the next one.